23% growth in retail, and corporate grew at 13% year-on-year. Our vehicle finance loan book grew 17% year-on-year, with full-year disbursements crossing 50,000 crore for the first time in our history. We had another strong quarter of business at Bharat Financial, with outstanding loan originated of 44,750 crores, growing at 10% quarter-on-quarter and 23% year-on-year. 43,750 is the loan outstanding. Our retail assets continued robust momentum with 9% quarter-on-quarter and 32% year-on-year growth. We aim to grow our other retail assets at a faster pace while improving the balance towards secured mix. We continue to scale up our new initiative with affluent grew by 24% year-on-year. NRI deposit grew by 33% year-on-year. Our digital platforms continue to show robust growth. Indi, the flagship digital platform for individual segment, is off to a strong start. And we now have 5 million install base and 1.2 million clients, with more than 9 million transactions being processed every month. On asset quality, we saw sequential improvement in asset quality, with slippages reducing across all segment units. Slippages for the quarter were at 0.44 versus 0.56 quarter-on-quarter. Full-year slippages were also lower at 2.08% versus 2.88% year-on-year. Credit costs for the year were at 113 basis points, well within our communicated expectation. We have maintained a healthy provision coverage ratio of 71% and carry a contingent buffer of rupees 100,000 crores outside PCR. Our profitability and capital adequacy. For the full year, financial year 24, our financial year 24 NII at 20,616 crores grew by 17%, while stable net margins at 4.26%. Our operating profit for the year was at 15,864 crores, grew by 10% year-on-year. Credit cost for the year moderated from 1.13% versus 1.37% year-on-year. Our net profit for the year was 8,977 crores, growing at 21% year-on-year with an EPS of 116 rupees. The financials were healthy for the quarter 4 as well. Our NII grew by 15% with NIM at 4.26% versus 4.28% YOY. Our PAT was at 2,349 crores, growing at 15% year-on-year. The annualized EPS was at 121 rupees per share. We continue to have healthy capital adequacy ratio with CET1 at 15.82% and CRAR at 17.23%. The board has recommended a dividend of rupees 16.5 per share for the shareholders. Our financial year 24 progress has largely been on track with our PC6 ambitions and across parameters. We remain committed to achieving our planning cycle 6 goals. We have shown healthy traction on all the key metrics and expect to show similar trends going into financial year 25 as well. Thank you, and we can now open up for question and answers.
Is the current quarter number, but this is slight dip if you compare even on quarter-on-quarter or year-on-year. I want to know, for the next year trajectory, you want you would like to aspire keeping it above 4%. What is your target?
So we've always set a range of net interest margin between 4.2 and 4.3, and we've always been in that range. You can't take a quarter or something as a thing and saying what has happened. It can fluctuate with the cost of deposits. So I think as long as we're between 4.2 to 4.3, we are maintaining our guidance on that.
Similarly, on deposit sides, you have mentioned it has been increased if you compare it with last year. Again, it is not this problem with one bank, but many banks are facing problem on raising deposits. What is your target for the current year in terms of raising deposit? Do you think there will be some pressure?
So I think deposits has been an issue with the liquidity remaining tight for the last 2 to 3 quarters. I think we've been able to manage well. We've grown 14% year-on-year on our deposits. We continue to believe that our retail growth of deposits will be higher and will match the asset growth. So we grew retail by 18% on the quarter. We continue to believe that we should be growing at 16 to 19% to match our asset growth ambitions of 18 to 22%.
Okay, last on your 56-44 ratio of corporate and wholesale. So what is your asset mix which you would like to continue? I mean, is it as per PC6? What is the guidance there?
So we don't give, we've always said our asset mix will be 55 to 58% retail and 42 to 45%, 42 to 45% corporate bank. And we've always done that. We've always been hedged towards that.
Sir, good evening, Piyush from FE. Sir, your OPEX is up 24% YOY. What is the core reason for that? Like Ankur sir was saying on deposits, CASA if we see Q on Q is down. So what are the drivers you are putting in? Because retail ones are coming but not CASA. So what are the levers you are putting in? And I just have one more.
So let me tell you, let me answer the second one first on the CASA, which is important. I think we are at 38% CASA ratio, and I think the whole industry has seen what we are seeing, because the gap between the rates of deposit, which your interest rates which you're getting on the CASA or SA versus the term deposits, the spread widened, and I think people moved the money into the term deposits rather than on CASA. Going forward, if you see the last quarter also, we've grown our savings account by 7% quarter on quarter. It's the current account which has gone down. And I think you will see that our savings account continues to grow healthy. But our current account, I think there is a struggle which is happening on the current account, specifically because the large corporates where we don't have more than 10% lending, they get impacted, and the CASA as a consequence, goes down there. We're focused on the MSME and the EC segment, which is the emerging corporate segment. And I think it's a slow and steady pace to replace that CASA. And it will take some time. And that's why the CASA is falling as a consequence. I believe that should come back. I think next year should be 38.5 to 39%. And then we will slowly take the journey forward. We've also launched a lot of initiatives to back it. I think we're working on one bank. So I think our vehicle finance as well as microfinance contribution towards the liability story has to increase. We believe that the bank has to differentiate itself in the offering. We believe community banking, specifically for us as a bank, has to be the differentiator going forward. And we believe we have 2 or 3 communities which we can make a huge impact. So for example, the Diamond, we are the largest financiers of Diamond. The Diamond community is about 1.5 to 2 million workers. And we believe it can easily take 5,000 to 8,000 crores of liabilities in the next 2 years in that business. We've launched a senior citizen program, and we believe that that's a very unique program which we are launching. And we believe we can believe 35 to 40,000 crores of additional liabilities which will come as a consequence of that. We've launched a woman entrepreneur program called V, and we believe that that's a very, very big community which we think can make a huge difference. So we are not going out in the market and saying just acquire a savings account. We are creating an ecosystem around communities, and we believe that's a unique proposition which we're going to come in various communities, and we will do that. That's number 3. Next, I think we believe that our approach towards branch expansion will continue. We are at 2,987 branches. We believe that we should go to about 3,500 branches in the next 2 years, and we'll continue to expand our branch network as we move along, because I believe that relationships belong to a branch and transactions belong to digital, and we will continue to do that. And last, we've launched IndieR, a dynamic individual platform, and we believe that that's going to be a unique feature where a client acquisition run rate, which is about 1.2 million, 3.6 million today, 1.2 million today should go up to about 3.6 should go up to 5.6 to 6 million customers in a year. And I think that will itself, with engagement happening through the thing, I think we should be able to create a huge platform on the retail liability. Your first question was on OPEX. Now, let me tell you, this bank, as a mid-sized bank, is on a growth bank. We are continuously going to invest in growth. As long as our financial vectors are between 1.8 to 2.2 ROA, our growth is between 18 to 22%, and we are able to deliver that, I think there should not be a problem in the OPEX. And I believe that if we don't invest now for growth, the growth and investments require investments in people. We've hired about 11,000 employees last year, and we continue to believe that we'll continue to invest in our employees as we go forward. Number two, our technology infrastructure, which we created, very robust. And I think we've invested a lot in creating a new data center, creating new backup system, DR systems. We've invested in client-facing technologies. We've created disaster recovery capabilities, which are real-time online replications. So I think that's an investment which we've done because we believe in today's world, the systems cannot be down. And you have to create online real-time systems to match that capability. And we have invested and continue to invest in these infrastructures as we move forward. Number three, we have invested in new businesses. I think if you look at the mortgage business, which is still very young, 1,800 crores, but I think that business will become 15,000 crores in 2 years. We want to invest. We are investing in that business. We've created capability building in that. We built capability to create scale in that business. We are investing in a merchant acquiring business where we've already got 5,500. We want to be 15,000 crores again in that business because the profitability of that business is very good. We are investing in distribution. We are investing in infrastructure. So I think that's very, very important, and we'll continue to invest. So I don't think a measurement of cost to income is the end game. I think it's as long as it's going towards growing businesses and investing for new future growth, I think it will continue to happen. You know, what you saw at 42, 43 was COVID times when the investments were low. As you grow out and you now get into the new India, which is a $5 trillion economy in 5 years' time, you got to invest to keep pace. And if you don't keep pace with these type of things, you'll not be able to compete in the market there.
So just yesterday, there was some action against a large entity by the RBI, especially in the digital side. So these investments will ensure that you avoid those sort of, failures in your systems. Exactly on digital side, a lot of incremental business is coming, right? So will we continue expanding our digital capabilities? What are the guardrails we are putting in to ensure that such action is not taken again?
So I think digital is here to stay. So you can't say that. I've said relationships belong to a branch. Transactions belong to digital. And I continue to believe in that. I think as you grow your businesses, every business, I can't comment on any other bank, but every other bank and every bank should evaluate its technology infrastructure to keep pace with the scale in operations which you are doing. I think your UI UX capability which you are building, I think fraud management capability and KYC capability on real-time online basis, that you are able to weed out the bad accounts and the good accounts very well. And I think that's a capability which we have also, we've learned over a period of time. So it's not that we were born with this. So I think we've learned, but are we fully there? I think it's an evolution. And if you are doing the right things and you can demonstrate the right things, that is more important. And I believe this is one line where I don't put budgets onto it. So they have to continuously expand in this sector. And I think you got to be in compliance with the regulatory guidelines. You got to be in compliance with what the competitive environment is. And your competition is not banks. It's the outside world, the fintechs, the QSS services. So you got to be there where the client's experiences matter. And I think if you are able to do that and have a clear policy on how you safeguard the client's data, as well as give seamless transaction capability, I think it's very important.
Oh, hi, sir.
Just as a follow-up to what he asked, are you reviewing some of your systems on the digital capabilities given the order that came out yesterday on one of your competitor? Put it on some sort of an audit internally?
So we continuously, our ITSC committee, which is the board level committee, continuously evaluates what is our capability, and also RBI evaluates our systems through C-site audit on an ongoing basis. We make sure that we completely on track on all these items and make sure that we are up to date on all these issues which are there. Of course, there will be gaps here and there, but I think as long as we know that there is an action plan and we are up there and informing the regulator as well as our clients as to what it is, I think we are completely comfortable. And in fact, when we launched digital, we didn't launch the digital through the existing systems. We launched system by creating a new payment capability and a completely new capability which we build in, so that the transactions and the payments are completely split to cater to the volume. We have 3 or 4 switches for the enterprise payment service. We don't depend on one. And that is very important because you clock the systems at that point of time. But the volumes are expanding at a very fast pace.
Thank you. Disbursements for the quarter and for YOY seem to have come down in March quarter, which is usually considered one of the brisk quarters for bank. Any particular reason why you decided to curtail a bit?
It was not by choice. I think we were migrating our vehicle finance business from a very traditional system to Finacle. And I think at that point of time, we lost some time as a consequence. And that impacted our disbursements in the vehicle finance business. We did about 11,300 crores of business, 11,800 against our target of 13,500. That's where the disbursements went.
Okay.
So we wanted to do the migration because I think it was very important for us to do the migration.
Some of the portfolios on the retail side, like two-wheeler loans, MFI, etc., they're continuing to show NPA slightly higher than what your past averages have been. Any guidance you'd want to give on that, sir?
So if you look at scooter loans, I think you have seen a portfolio only declining. And I think where we went wrong, after COVID, the rural segment, specifically in the self-employed, has not recovered that well. And I think that is where our scooter loan business went down. And the scooter loans have now started picking up. If you look at the OEM's data also, the rural segment has now started picking up for them. And that's where the business got impacted. We did not want to do a restructuring of that portfolio. We never gave restructuring or followed a CGT as well. We just took the losses. And I think you should see a better improvement in the years to come on that portfolio, in the months to come. On the MFI, I think we are doing very well. Now, MFI, I have always said that the gross flows in this system will be around 3% to 3.5%, and the credit cost will be around 2.5% to 3%. You can't run an MFI system business lower than that. And I am of that view. We don't do top-ups. We don't do smaller loans. I don't believe that that's the model. I don't do any restructuring, or I don't do any top-ups. So I think that's the way we want to run it. And we believe that we're very comfortable with 2.5% to 3% credit cost on the MFI system.
Hi, sir. Siddhi here from Reuters. Hi. I just wanted to ask you about any color that you could give on the lending side on the loan growth. This is a new fiscal year. We are seeing tight liquidity conditions and banks are kind of trying to reduce their loan to deposit ratio. Do you think, how do you think that will impact your loan growth in this year? If you could give any numbers, any guidance, I'll come back to my next question.
So we've not changed our guidance, but we remain watchful of the inflationary environment and the rate environment. So it's not that we will do growth for the heck of growth. We are very comfortable with our LDR ratio today. And I think if you look at our stable funding ratios also, we are very comfortable. I continue to believe that as long as you watch out for the stable funding in your businesses, and you watch out for the LDR between 88 to 90, and we've not busted that, I think we've been very, very comfortable in that range. Of course, if we find that we're not able to mobilize and granularize our liabilities, of course the growth will slow down. But we are not seeing any rationale for the growth to slow down as of now in our businesses.
Any numbers, sir, if you could give for the entire, any target for loan growth?
We've always said our PC6 numbers remain intact. We've said 18 to 22%, and we've not changed our guidance on the growth path.
Okay, so my next question is, has there been any indication from the promoter about RBI allowing them to hide stake in the bank? Has there been any communication?
So we are not privy to that communication. And I think whatever is happening between the promoter and the regulator is between them. Whenever we are asked for any information or data to be provided, we provide. But we are not privy to what the progress on that thing is.
Hello, sir. I'm Himansa from NDTV Profit. So my first question is, in the last quarter, you had said that your AIF exposure is around 113 crore, and you were not you're not provided for it, but you're looking to sell. So what is the status on that?
We sold it. That's it. We don't have any other AIF exposure.
Okay. And so the next question is, it's a marginal dip in the capital adequacy ratio. If you could tell us where is it coming from?
So there are two things which happen at this time. One is you take an operational risk at this point of time. Second, we also, matured our 81 bonds of 1380. Huh? 81 bonds of 1490 crores. So that's the impact. And but I think if you look at it, that would have been a 40 basis point impact. But our business CET has fallen down by only 2022. This is because our weighted average on the assets have reduced, and that the capital adequacy has improved in that business. So we are very cautious about how we use our capital, and that's why we do corporate, because we do A-rated and a paper and above, and that's why we managed our capital.
So if you could give some numbers on how much you have, how much is the IT expense, IT related operating
It
expense?
ranges between 8 to 10% of our overall expense. So that will continue to be there. Overall cost to income, the expense. Total cost to income.
8% of total cost is IT expense.
Yes. We invest a lot. So for example, we have the best data warehouse. We've invested in the latest technology on data warehouse.
Any part of it to balance sheet show it as assets, or all of it is taken into account?
So it depends. If it's a SaaS type of a thing, then it's an operating expense. So if it's a capital expenditure, then it's depreciated over a period of 3 years or whatever that term is.
Hi.
Hi,
Yeah.
Janet here from Money Control.
Yeah.
I've got a question on recoveries here. So just wanted to get some numbers or some outlook you could give for recoveries in FY25.
I don't think we can give any recovery numbers. I think it's not fair. I think we can give a guidance only on the credit cost, and we said 110 to 130 basis points. That includes recoveries also.
And one more on so RBI has been telling banks to work on transmission of the rates, lending and those rates. So just wanted to get a sense on, is your bank looking at hiking rates anytime soon?
Why would you hike rate if RBI has not hiked the repo rate? If you are linked to the external benchmark rate, you will pass as per the external benchmark rate. The fixed deposit book works on a fixed deposit, on a fixed rate. So I think you can only hike rate if the external benchmark rate to which you are linked to hikes. And all these are linked to EBLR, which are 90-day treasury bills, 1-year treasury bills, or anything. You can't hike the rate like that.
Either EBLR or MCLR.
Yes.
Right. So both are linked to the market individual.
So I think 28% of our book is linked to EBLR, and the balance 24% is linked to MCLR, right?
50% is fixed rate.
And 52% is fixed rate book.
This is Mayur Shetty from Times of India.
Hi, Mayur.
Congratulations on your 30th anniversary. So, 30 years back, the systems were all state-of-the-art core banking. But now there's talk that these are monolithic structures and not suitable for digital age when you're having billions of UPI transactions and online transactions. So, I know this is a bit of a repetition of what is already asked, but could you tell me, like, whether these systems are capable of handling the present-day digital transactions, and whether you need to make
How
any
you
changes?
define architecture for any bank is very important. So, I gave you a little bit of a insight. You can't have transactions hitting your system at that rate. The TPS, transactions per second, is a very important parameter on core banking systems. And how you box the system and then store and forward your transactions is a very important capability in that. And you got to use different switches to do that. And I think we use 4 types of switches in our ability. So we were the first to implement an enterprise payment hub on a cloud. We also use different other microservices basis cloud switches. Plus we also have another system which we use on ND, which actually flows a lot of transaction into a different, which is also on microservices based architecture. So you got to, the traditional switches may not be able to handle that type of volume. So how you create an architecture in your capability and how you manage these systems is a very important part in the new design of the system. And you got to have a near-time disaster recovery. And this is a cost associated with them, that you're replicating your infrastructure. You should be able to bring the system in a split of a second. The client never feels the system is down.
One more question was on the Reliance General Insurance and Reliance Insurance. Have you all signed a contract for corporate agency with the insurance companies?
We have not signed as of now. I think whenever we sign a contract with any distributor for distribution of insurance or any other product, we do an RFP process. The bank has to follow an RFP process and then we do it. We have two partners as of now, which is Tata AIA as well as ICICI Prudential. So we deal with them right now on the life insurance.
Thank you.
This is Ben from the New Indian Express. Your sales team, credit card sales team seems to be very active. I keep getting calls almost twice a day. How good is the asset quality? How big is the book? And because there are the credit cards, because your sales team is very active.
Do you take it as a compliment or it's a, what do you want to say?
Neither I am complimenting.
See, I'll tell you, we are not a large player in credit cards. We have a 2% market share, 2.1% market share in credit cards. And we like customers like yourselves. We don't give lower end credit cards. We are a higher end credit card business, and that's why we have a market share of 4% on the credit card business. For the spends. We continuously believe that credit card is a very engaged product for a wallet entry into other products of the client. And I continuously believe that you don't have to do so much of it. You've got to do the right forum, and that's why we'll never be a leader on credit cards. We'll always be a 2 to 3% market share on credit cards, and we are fine with that credit cards. Our credit card portfolio, you will see the data in the investor presentation, is at a delinquency of 2.57, gross NP of 2.57%, and it has an ROA which is very good for us, and it's a very good business for us as of now. So it's a small business of a 10,000 crore portfolio, but a very nice and a very niche business for us.
Why do you say you don't want to be a big leader?
I somehow think you have to have a right to win in whatever businesses you do. If you look at businesses where we do well, are businesses like microfinance, businesses like vehicle finance, businesses like diamond. We're in troubled times also in diamond. We've not had any SMA 0, 1, 2. We continue to believe that customer pricing, loyalty, as well as the stickiness comes when you create a very right to win. I think in credit cards, if we have to compete, our expenditure and cost to income ratio in the initial phases will be about 300% to 400%. Number one. Number two, I continuously believe that we want to do it for our own clients, and we will grow the credit card not by acquiring through DSAs or outside agents. We want to penetrate our own clients much more than doing it through our outside agency. And as soon as Indy takes off in the way we want to take off, we will start cross-selling credit cards into our base rather than saying that and there the cost of acquisition will be negligible and the efficiencies of the business will come in. So that's our approach, and I've never said never. We will do it at the right time with our own client base.
And what is your diamond financing book? How big is the book?
It's about 7,500 crores today. It was 11, less than 3% of our book, and it's a business which we are very proud of.
Okay. And the asset quality of the personal loans, unsecured loans?
We are one of the best in the industry. I can tell you this much. We have 0.8% delinquency on that book. 0.8.
Quite well in the current, quarter. So
you asked two questions at one go. So you tell me which one to answer first. So let me answer the second one first. 72% of our business comes from consumer bank, retail bank. Retail bank business is very granular, so it doesn't have anything. And the balance 28% comes from 200 crores come from global markets, and the balance comes from the corporate bank. About 480 to 500 crores comes from corporate bank. Having said that, I think, so we continue to believe that granularity, and as we grow our consumer franchise, and specifically the Pioneer as well as the retail franchise, we continue to believe that our business will continue to do well on the fee side of the business. Coming to the corporate side, if you look at the corporate side, I think 45% of the book 20% of the book is large corporates, 15% of the book, 25% is large, 15% is mid corporate, and 5% is small corporate. The small corporate, though coming from a smaller base, we've gone 33% on that book. The mid corporate, which includes gems and jewelry, has grown by 8%. But if you the mid corporate has seen a decline in the gems and jewelry, and that's why it's 8%. Otherwise, it was 18%. And the large corporate grows in line with the market of 13%.
Any guidance for corporate and other income?
Again, I told you that our mix will be this and our growth will be 18 to 20. It's a very simple guidance.
How much fresh slippages are there in this quarter?
So we have a slippage of 2.02%, which is about 1,420 crores, and against the 1,785 last quarter.
Okay, and any particular sector accounts?
All have shown a decline for us. So corporate, MFI, other retail, as well as this thing, CF, vehicle finance, have all shown a decline.
So could you repeat that loan book mix between how
56-44.
56?
So, you've been seeing an extension of corporate loan growth question. You've been saying that you've been very selective in the corporate loan, but especially the large corporate segment. Has that continued this quarter, or are you seeing the environment improve a little bit? Are there certain pockets where you're seeing growth coming from?
So I think we see growth in very specific segments in the corporate. We have a right to win in certain segments, which are real estate, NBFCs, agri and food processing industries. So I think we do very well in those segments. We've seen some growth in the NBFC segment and in the food processing segment this quarter.
But are you still being very selective and cautious? Is the environment still difficult? Are you not seeing broad-based corporate?
See, I've told you, we will play in areas where we have a right to win. Our cost of deposit does not allow us to play very big corporates in the very big way. So we are very selective and we create very niche opportunities for ourselves. And that's why our good book is in line with the market. We don't do any investment banking fees now in corporate.
Two questions. What contributed to your profits for the quarter?
Sorry?
What were the factors that contributed to 21% growth in net
For the
profit?
full year?
For the full year, yeah, or quarter, like.
I think 3 or 4 things. One is our growth in the asset book. And I think our yield improvement across the book, which took care of the cost of deposit increase and be able to maintain the sustainability of the NIM. 4.2 to 4.3. Actually, we've been in 4.25 to 4.29 forever. And I think we've done very well there, number one. Number two, our fee to assets is one of the highest in the industry at 1.9 to 2%. We continue to believe that, and we continue to do that very well. And third, our provisions coming down as a consequence of that, and the risk cost coming down as a consequence.
What about your any new business investments? Like there have been talks about your mutual fund investment in mutual.
We have to await the license from the regulator for us to get into the parabanking activity. So we still await the license from the regulator.
But you're not planning any investments in an existing.
Which existing? We don't have a business.
No. Any new venture, existing portfolios are you trying to
Acquisition.
Sorry, I meant acquisitions. Are you?
We
planning?
continue to evaluate acquisitions, but it has to fit 3 criteria for us. It has to be ROA accretive, it has to be complementary to our business, and it has to give us a capital accretion also. So I think we continue to look out. But today, if I tell you I'm interested in these, it does not make sense. So as long as we find a right fit, we will get there.
We will take the last 2 questions.
Okay, I think the food is served. We can have, and I'm here. If you want to interact with any other things on a personal one-to-one basis, we can interact. Thank you so much for your time, and sorry for the delay of 15 minutes for the thing to get uploaded. It just took that much of time. Thank you so much.